What if I told you there's a fund right now that's yielding over 25%, pays you every single month, and has returned more than 10% in just the last 3 months? Sounds like clickbait, right? But it's real. And I hold over $24,000 of it in my own portfolio today. Most people, they ignore it, and some may even call it a trap, like a dividend trap. But I'm here to show you how exactly and why exactly this fund might be one of the most misunderstood ETFs on the market today. And that's why I'm betting big on it, as much as you can consider it a bet. But stick around and I'll walk you through the structure, the holdings, the recent performance, and why I'm not just holding, I am confidently holding and continuing to grow my position. Let's go. Hello all, Rico back again with another one of my biggest holdings. I've been buying this fund and I'm pretty stoked about it and its performance for me so far. As always, this is not investing advice. This is for entertainment and inspiration purposes only. Always, always, always do your own research, please, and never blindly follow anyone like myself on YouTube. Okay, let's start first about what this ETF actually does. And what we're talking about today is FEPI. This is the REX FANG and Innovation Equity Premium Income ETF. FEPI follows a clear and powerful structure. Own big tech, write covered calls, and deliver enhanced income potential through monthly distributions. But let me break it down using the fund's own description, then I'll translate it into plain English for you, right? So this is going to be a lot of jargon, but follow me, okay? The fund seeks to generate current income from option premiums by writing, i.e. selling, covered call options on the fund's portfolio securities. The writing of a call option generates income in the form of a premium paid by the option buyer. The fund's investment strategy is to write call options that are slightly out of the money, which will allow for some capital appreciation as well as income generation. The degree to which the fund's written call options will be out of the money when written will depend on market conditions at the time. However, the fund intends to target written call options that are not at or in the money. Okay, that's a mouthful for sure, but this is what that means for you. So FEPI, it actually buys tech stocks, not just the options. So they actually own the underlying stocks. Then it sells covered calls, basically renting out the stock each month for a fee, and that fee is called a premium. The calls are usually just outside of the money, so if the stock runs up, there's still room for a little capital appreciation before the shares are called away. So you can participate in that upside. You earn cash from the premiums, plus, like I mentioned earlier, you still get the upside. And this is key. This is the key part here. FEPI holds the actual stocks, like I said earlier, not synthetic derivatives. That gives you more stable performance and real growth exposure. Now, let's talk about the holdings and how the actual portfolio is built. The fund's investment portfolio is constructed with the same securities and same equal weighting as is done by the index. The fund's portfolio is rebalanced and reconstituted in the same frequency as it done by the index. While market capitalization, weighted indices can be dominated by a few of the largest stocks in the index, the advisor believes that an equal weighting allows for a more diversified portfolio. So again, that was in the own terms of FEPI, taken directly from the prospectus. So to put it simply, the fund doesn't overweight mega cap tech. Instead of letting Apple or Microsoft dominate the portfolio, every stock is treated equally. That benefits you in a few ways. So one, it's just better diversification. Next, you have more upside exposure from smaller innovators and maybe up and coming businesses. And there's less risk of one name dragging the whole portfolio down. So Tesla's been super volatile, it won't bring everything down. And because it's rebalanced monthly and reconstituted quarterly, it keeps that balance intact. And a lot of these companies, they're not unknown companies either. The fund holds Palantir, AMD, Alphabet, aka Google, Salesforce, Broadcom, Amazon, NVIDIA, Apple, Microsoft, Tesla, Netflix, all probably things you have owned or have used before, right? And I've worked inside some of these companies and I've led creative teams at Netflix and Zappos, and I know how real innovation looks on the inside. That's part of why I truly believe in this fund. So why are people down on FEPI? It's a great question. But to answer that, we need to go back and look at what happened in April. So if we go back, April 28, 2025, the president announced that he would enact across the board tariffs. And if people didn't come to the table with new deals, he would just apply them across the board. And that news spooked the entire market. But big tech got hit especially hard, and so did this ETF, which it entirely is made up of those innovation giants. So with the China tariffs and things like that, with a lot of these companies doing their business in China, nobody knew what was going to happen. And then over the last 6 months, the fund's price was down as much as 8%, hitting a low of $36.99. And that sell-off caused a lot of panic and a lot of short-term exits. So thus you see the nosedive back just before Liberation Day. But here's what people missed. They missed the actual comeback from FEPI. Since that April low, the fund has actually rebounded quite nicely. If you look at today's stock price, which we'll go over in a minute, it's been a pretty good story. So let's break down where it stands as of the day of this recording, July 28, 2025. The share price is now back up, not to its high, but it's at 45.71, and the dividend yield is just over 25% at 25.48%, and it pays out $11.65 per share. And remember, this is monthly payouts, but that's the annual total, right? And the 3-month total return, so if we look at where it was Liberation Day, 3 months, 10.36% total return. And that's a strong comeback. It's quiet and it's consistent. That's what I enjoy about it. And that is why I added 513 shares of FEPI to my portfolio back in late May, and my average cost is about $43.94. And I'm slowly reinvesting a small portion of my distributions back into FEPI to continue to grow my snowball and give myself a raise month to month. That's why you see my average cost is going up, because I'm in FEPI reinvesting every month. And that's about $24,000 that I've put in so far, and I'm continuing to add to that position. So where I stand today, I've seen so far since the end of May a total return of 8.1%, an internal rate of return of just under 14%, and a distribution yield of just over 26%. So for me, it's been performing really well, and why I'm still in it. I'm not even thinking about exiting. But if you see my other videos, I spend 30-45 minutes a day looking at these positions and analyzing them. Outside of that dip in April, again, tied to all the tariff scares and everything that was happening, the fund has been incredibly consistent. So if you look, we're seeing monthly payouts ranging between 90 cents and $1, and they keep coming, and it's consistent. And that's powerful income, and it certainly adds up fast, especially if you put some of that back into the holding. So here's the big question. Why do I continue to buy and hold FEPI? And it's a good one, but it's because this is more than just a high yield play for me. This is more than just finding the highest distribution yield. I've spent over 20 years in tech building some of these teams, whether it was at Netflix, Zappos, Amazon, and I've seen firsthand how innovation changes and pushes everything. And tech isn't just another sector. It's the engine that powers our future, the way we do things that are going to make our lives easier. Whether it's from cloud storage to AI, from entertainment to productivity, we're in a time where the last 25 years has moved us further than the previous 1,000 years combined. And it's not slowing down. Yes, it's volatile. Yes, it is fast moving. And yes, it is sometimes controversial. For sure, it's tech. But the growth, the possibility, the global impact, I'm all in for that. And that's why I believe in tech and why I believe in FEPI, because it doesn't just bet on the future, it pays me while I wait for it. Just to wrap up, I want to ask you, would you invest in a fund that's volatile but pays you monthly, yields over 25%, and has bounced back more than 10% in just 90 days? Comment down below on your thoughts on FEPI, and if you're bullish or you're bearish on this ETF. Are you holding FEPI? Did you sell it during the pullback? Or are you now just looking at it again, maybe looking to get your feet wet, see what FEPI is all about? I'd love to hear from you in the comment section. And FEPI might not be the right fit for everyone, but if you're looking to blend income with innovation, this fund deserves a second look, but only if you can stomach the volatility, sometimes controversial approaches, and the intensity that comes with big tech. All right, that's going to do it. If you haven't already, please like, subscribe, and follow for more deep dives into dividend strategies, tech investing, and how to create freedom for yourself. Thank you so much for watching. Remember that messy action is better than no action. Take care, and I'll see you next time. Boom.